With a few exceptions, most investors should be using low-cost index funds as their primary investment vehicle. Anyone who disagrees with that statement is probably misinformed, conflicted, or just plain wrong. This is nothing you haven't heard me say before, but I want to make the case for low-cost index funds in a single video that can be shared with people who are still investing in high-fee, actively managed funds, as many Canadians are. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to make the case for low-cost index funds as the most sensible investments for most people. The case for index funds breaks down into 6 simple but important points, each with supporting theory and evidence. Cost efficiency, diversification, investment returns, tax efficiency, simplicity, and theoretical consistency. Before I get there, I want to start with some background on index funds. I also want to mention that I have some words of caution that I hope you'll stick around to hear at the end of the video. An index is a grouping of stocks designed to represent a market or market segment. For example, the S&P TSX Composite Index is designed to be representative of the Canadian stock market. S&P comes up with a list of company names and weights based on the relative sizes of the companies. This is called a market capitalization weighted or cap weighted index. The S&P 500 is similarly a market capitalization weighted index, in this case representing 500 leading US companies. A cap-weighted index will always have more weight in larger companies like RBC and Shopify in Canada, or Apple and Microsoft in the US, and less weight in smaller companies that you're less likely to have heard of. Market cap weighting is simple, based on market prices, and easy to implement, which likely explains its widespread use in both benchmarking, evaluating the results of another investment strategy, and index investing, creating funds that track an index. An index fund is a mutual fund or ETF that tries to replicate the performance of an index, usually by investing in the stocks in the index. When I say index fund throughout this video, I'm referring to cap-weighted total market index funds that aim to capture the returns of a total stock market. As I'll explain later, not all index funds are created equal. To contrast, an actively managed fund aims to outperform the market index by doing things like selecting a subset of stocks within the market and timing exposure to the market in an effort to outperform. Over the last 60 or so years, index funds have gone from being a fringe idea in academic circles, an idea that the asset management industry liked to criticize and even laugh at, to becoming a mainstream investment vehicle. This did not happen by accident. A huge body of academic research starting around 1968 and continuing to today has shown that actively managed funds do not add sufficient value to cover their relatively high fees on average, and that the vast majority of active funds underperform in the long run. This brings me to the first point in making the case for low-cost index funds. Index funds have low fees. The weighted average fee for index funds in Canada is 0.19%, while for actively managed funds that do not have the cost of advice built in is around 0.85%. Those higher fees on average will translate to lower investment returns and no other identifiable benefits unless you really like supporting your fund manager. Research from Morningstar has found that fees are one of the best predictors of future fund performance. Vanguard's late founder John Bogle famously said that in investing you get what you don't pay for. His point was that unlike other areas of life where paying more comes with the expectation of better results, paying higher investment fees typically results in lower returns, not higher. A point corroborated by research from Vanguard. Formalizing this logic, Nobel laureate Bill Sharpe explained what he called the arithmetic of active management in 1991. If active and passive, another name for index investing, management styles are defined in sensible ways, it must be the case that 1, before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. And 2, after costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. This suggests, in simple terms, that in aggregate, investors in actively managed funds must underperform investors in total market index funds because active funds have higher fees and costs. Multiple academic studies have found this to be approximately true. Before fees, there is evidence that active funds add a bit of value on average, but net of fees, all credible studies agree that the average active fund is not adding value. In addition to fees, investors in a fund pay transaction costs. In Canada, a portion of these costs are reported as the trading expense ratio, or TER. Index funds tend to have very low trading expense ratios, often rounding to 0%, while actively managed funds, which typically trade more, tend to have higher transaction costs. It's not uncommon for the trading expense ratio of an actively managed fund to be higher than an index funds' fees and trading costs combined. As important as fees and costs are, a lot of people are not aware that low costs are one of the benefits of index funds. Only 31% of respondents to a 2022 survey of Canadian investors knew that index funds have lower fees and expenses than actively managed funds. As important as they are, fees are not the only reason that actively managed funds will tend to underperform. Their relative lack of diversification also poses a challenge. This brings me to the next point. Index funds are broadly diversified. By replicating the returns of a market index funds hold a huge portion of the stocks in the market. On the other hand, in their efforts to beat the market, actively managed funds will tend to hold fewer stocks. Portfolio concentration can be a good thing if a fund manager knows how to pick winning stocks, but picking winning stocks consistently is really hard. Stock returns are positively skewed. This means that most stocks don't perform very well in the long run, while a relative few perform exceptionally well. The result is that while the long-term return of the overall market is positive, the majority of individual stocks underperform. Based on data from 1926 through 2016, only 42.6% of US stocks had lifetime buy and hold returns that exceeded 1-month treasury bills. Just over 50% of US stocks had negative lifetime returns, about 12% of US stocks lost 100% of their value, and only 30.8% of stocks generated lifetime buy and hold returns that beat the market. Suffice to say that most stocks do not beat the market over their lifetimes. The data for global stocks are even more discouraging. If a fund manager identifies those relatively few winners ahead of time, they will generate high returns, but they are much more likely to end up with losers. Index funds, on the other hand, always hold the winning stocks. This idea was detailed in the 2017 paper Why Indexing Works, which, separate from fees, helps to explain why active managers tend to underperform a benchmark index. This brings us to the next point. Index funds beat the vast majority of active funds. In a 2023 study looking at long-term returns for US equity mutual funds from 1991 through 2020, the authors find that most funds underperform an index fund, even before fees, while a few funds win big. This is important. Multiple studies, including this one, find that the average active mutual fund slightly outperforms before their fees. But this study shows that most funds, 54.8% of them in the sample, underperform an index fund even before their fees are considered. The explanation is that the skewness in stock returns makes it more likely for active mutual funds to pick losing stocks than to pick winning ones. After fees, only 30.3% of US equity mutual funds in this study beat a US equity index fund over the full sample. Other research like the S&P US SPIVA report finds even lower rates of outperformance. For example, for the 20 years ending June 2024, fewer than 6% of US equity mutual funds in the SPIVA report beat the S&P Composite 1500 index. The OG 1968 paper that introduced the idea of evaluating mutual fund returns on a risk-adjusted basis and introduced the term alpha to define excess risk-adjusted returns found that 115 mutual fund managers in the period 1945 to 1964 were, on average, not able to outperform the market. In fact, there was little evidence that any individual fund was able to do significantly better than what we would expect from random chance. An influential 2010 paper similarly found that net of fees, the average US equity active fund underperforms, and again, that the distribution of fund returns is in line with what we should expect by random chance, before fees, but discouragingly worse when the higher fees of actively managed funds are taken into account. A 2014 paper examines data on global equity funds and comes to similar conclusions. Active management is a zero-sum game before fees, and a negative-sum game after fees. These data suggest that you are much more likely to underperform than to outperform by investing in an actively managed fund, though there's still a small chance of picking a big winner. The obvious next question is whether you can identify those big winners ahead of time. A lot of investors look for active funds that have beaten the market in the past and hope that they're going to continue outperforming in the future. This is the question of persistence. Unfortunately, there is little evidence that the best performing active managers from a prior period continue to outperform in future periods. There are a couple of potential explanations for this. One, as described in a highly cited 1997 paper that does not mince any words, is that the data do not support the existence of skilled or informed mutual fund portfolio managers. Basically, managers who were successful in the past were simply lucky, and their luck eventually ran out. Another possible explanation, described in a highly cited 2015 paper, is that mutual fund managers are skilled, but their skill does not translate to higher returns for fund investors. Instead, assets flow into the funds of skilled managers right up to the point that the fund gets too big for the manager to continue outperforming due to diseconomies of scale. The result is that the most skilled managers earn huge fees by having large funds, but the benefits of their skill accrue to them, the fund manager, not to their investors. In either case, luck or diseconomies of scale, there is a lack of persistence. This is important because there will always be some active funds that have outperformed in the past. But that doesn't matter if you can't identify the future winners ahead of time. In the long run, index funds beat the average active fund and the vast majority of active funds without the need to worry about whether you've picked a winning manager. I've had people ask me why you would settle for average returns with index funds, but the reality is that index fund returns will almost always be way above the average active fund net of fees. Index funds are also tax efficient. More trading inside of an active fund will tend to lead to more taxable distributions, which can be an additional drag on long-term returns. Research comparing before and after tax returns of actively managed funds and index funds has found that however bad things look for active management before taxes, it looks worse after taxes for taxable investors. One of the biggest but often overlooked benefits of index funds is their simplicity. If you invest in actively managed funds, it is often difficult to evaluate how you're doing. Is the manager doing what they're supposed to be doing? Have they lost their edge? Has their fund gotten too big? With index funds, you can be pretty confident that you will earn the return of the index net of some predictably low fees. That is very easy to evaluate and to stick with. Similar to how you get what you don't pay for in investing, you also tend to keep more of your returns by doing less. This idea was popularized by the 1975 paper, The Loser's Game. The author describes winners' games, where the outcome is decided by the winner, and losers' games, where the outcome is decided by the loser. Winning a winner's game requires exerting effort to win, while winning a loser's game requires minimizing your mistakes to avoid losing. Investing is a loser's game. One of the author's prescriptions to avoid mistakes is to keep things simple, something index funds accomplish easily. The author wrote, "If you can't beat the market, you certainly should consider joining it. An index fund is one way." The data from the performance measurement firms show that an index fund would have outperformed most money managers. The final point I want to make is that index funds are consistent with foundational finance theory. Harry Markowitz developed modern portfolio theory in the 1950s on the basis that optimal portfolios minimize variance for a given level of expected return, or maximize expected return for a given level of variance. This is accomplished through diversification. Markowitz showed mathematically why diversification is so important. Bill Sharp's 1964 capital asset pricing model, or CAPM, turned Markowitz theory into a testable prediction about the relationship between risk and expected return. In the CAPM, each asset's price is based on its contribution to the risk and expected return of the overall market. One of the big insights from the CAPM is that in an efficient market, the market capitalization weighted total market portfolio is the portfolio with the optimal risk and expected return trade-off. Whether markets are actually efficient enough for the market portfolio to really be the optimal portfolio is an important question. While it's an ongoing debate, Eugene Fama's work on market efficiency starting in the 1960s and continuing to today suggests that markets are efficient enough that most investors should act as if they are efficient, even if perfect market efficiency is an unrealistic ideal. To be really clear here, perfect market efficiency is not something even Fama believes in. On my podcast, we asked Fama how we can know whether markets are efficient, and he said that at least from the perspective of investors, the fact that pre-fee active mutual fund returns look roughly like what we would expect by random chance, while net of fee active fund returns are a negative-sum game, is the strongest and most relevant evidence that markets are at least efficient enough that investors should treat them as efficient. Together, the works of Markowitz, Sharp, and Fama, all recipients of the Nobel Memorial Prize in Economic Sciences, suggest, theoretically, that most investors should own the market through low-cost index funds rather than paying high fees trying to beat it, an assertion supported by the evidence presented earlier in this video. I do want to offer a word of caution. I have been talking about total market index funds. Today, there are more indexes than there are stocks. Think about that. Many of those indexes and the funds tracking them look more like actively managed funds than total market index funds. This issue was detailed in a 2019 paper, Passive in Name Only, Delegated Management and Index Investing. Not all index funds are good investments. One glaring example is thematic index funds, which aim to capture the performance of hot investment themes like crypto, AI, or electric vehicles. They tend to launch at the peak of investor excitement for the theme, cannabis is another one, and then go on to deliver staggeringly poor performance. Similarly, using index funds to bet on industries is probably not a good idea, as I detailed in a recent video. The type of index funds most investors should be looking for, as supported by the theory and evidence presented in this video, are capitalization-weighted total market index funds. I think it's also important to mention that people often take index funds to mean S&P 500 index funds. While the S&P 500 represents a large portion of the US market and has performed incredibly well, especially in recent history, it's probably not the only index you want to invest in. Adding exposure to the rest of the US market and to stocks in other countries is probably sensible. Here in Canada, we have a ton of asset allocation ETFs that deliver low-cost, globally diversified index fund portfolios in a single fund, further simplifying the implementation of these sensible ideas. Index funds have low fees. They are broadly diversified, and largely due to those two characteristics, they beat the vast majority of actively managed funds most of the time, and especially at long horizons. They're also tax efficient, simple to understand and implement, and consistent with financial theory. Canadians have been particularly slow to adopt index funds. I hope this video helps to change that. Thanks for watching. I'm Ben Felix, Chief Investment Officer at PWL Capital. If you enjoyed this video, please share it with one of the many Canadians who are still investing in high-fee, actively managed funds.